Global markets began the day with a sharp recalibration of approximately $140 billion, signaling strategic repositioning by institutional investors reacting to recent geopolitical and macroeconomic developments. Equity indices oscillated between modest gains and losses as traders assessed a mix of corporate earnings and tariff headlines. Bitcoin tested the $115,000 level before rebounding, suggesting selective accumulation triggered by stablecoin regulation clarity. Simultaneously, the 10-year U.S. Treasury yield hovered near 4.41%, reflecting shifting inflation expectations. Commodities diverged, with gold strengthening as oil softened on revised demand estimates. Bitcoin steadied around $118,700 amid renewed optimism tied to upcoming trade negotiations between the US and Europe, offering reassurance to crypto holders. Ethereum surged toward $3,798, fueled by institutional appetite and headlines indicating stablecoin legislation is advancing into the Senate Banking Committee. XRP and other mid-cap tokens experienced sharper corrections, an expected result of market rotation toward top-tier assets. On-chain data reveals sustained large wallet accumulation at current price levels. The crypto market's resilience today contrasts dramatically with yesterday's volatility surge, exceeding $300 million in liquidations. Traditional equities exhibited regional divergences. U.S. stock futures edged up modestly, while Asian markets rallied significantly driven by trade optimism. Japan's Nikkei surged approximately 1.6%, supported by a weakening yen and improving trade dynamics. Europe's Stock 600 and FTSE 100 also climbed after reaching intraday highs, reflecting positive investor sentiment across continents. Equity strength was supported by strong earnings from select large-cap firms and upbeat forecasts tied to trade deals. The global rally suggests momentum beyond a simple crypto-driven narrative. Tech sector dynamics diverged. Alphabet shares rallied over 3% on strong earnings in cloud and AI revenues, contributing to renewed investor confidence in innovation-led growth. In contrast, Tesla shares declined significantly, with management warning of upcoming rough quarters and cyclical headwinds in EV subsidies. This divergence marks an inflection point in investor rotation, as growth remains attractive but with growing selectivity. Semiconductors and cloud infrastructure firms rallied on strong broader tech sentiment. However, lower sentiment in high beta names suggest caution remains warranted. Treasury markets exhibited notable though orderly changes. The 10-year note yield slipped back below 4.41%, while foreign inflows, particularly from Japan, helped stabilize U.S. bond prices. A successful $13 billion 20-year auction further underscored demand, containing yield spikes. The yield curve remained inverted at short to mid sections but grounded by investor demand for duration starts. Mortgage rates saw a slight uptick in the mid-6% range, a modest effect on housing affordability. The bond market's resilience underscores the balanced investor stance today. A newly finalized U.S.-Japan trade agreement and ongoing U.S.-Europe tariff discussions bolstered risk appetite after earlier geopolitical jitters. The agreement to cap tariffs at 15% on key industrial sectors removed uncertainty for auto manufacturers, leading to futures strength. Commodity-linked equities responded favorably, while defense and safe haven sectors moderated. Asian stock rallies reflect increasing confidence in rational trade policy. Investors responded positively to macro clarity, rotating into cyclical and export-sensitive assets. In Europe, equity gains were supported by resilient corporate earnings from firms like Reckitt Benckiser and BT, enhancing sentiment despite energy and inflation pressures. Eurozone inflation remains sticky, preserving pressured bond yields and complicating ECB policy outlook. Energy sector volatility remains contained, as OPEC output stability tempered gas and oil price retrace. FTSE 100's intraday high momentum signals improving investor appetite. The region's balanced economic signals suggest cautious optimism embedded in asset prices. Cryptocurrency regulation advanced significantly as the Senate Banking Committee published a discussion draft that defines market structure and aims to clarify stablecoin frameworks and exempt ancillary assets from certain securities regulations. A parallel Senate Agriculture Committee draft is expected in September to clarify CFTC jurisdiction over digital commodities. This regulatory push builds on last month's Genius Act, which formalized stablecoin oversight and licensed issuance standards. The regulatory environment is evolving toward a coherent statutory framework. Market investors may capitalize on improved policy clarity in crypto corporates and assets. Stablecoin ecosystem continues to expand following the Genius Act, enabling issuers such as Circle and Coinbase to pursue regulated charters. Institutional stablecoin reserves are increasingly regarded as treasury diversification tools. However, Circle's share price declined after a downgrade by Compass Point citing economic caution. This stock reaction reflects growing investor sensitivity to regulatory changes despite potential market expansion. Long-term structural adoption strategies may favor issuers who meet new compliance standards. On-chain data confirms a noticeable pickup in Bitcoin and Ether accumulation among institutional wallets since regulatory clarity emerged. Large volume transfers off exchanges signal increased custody demand and reduced speculative behavior. Meanwhile, crypto derivatives markets reflect moderate volatility levels, evident in controlled IBV and ETHIV levels. Liquidation events exceeded $300 million intraday, yet markets quickly recalibrated. This pattern validates a maturation process where volatility provokes disciplined accumulation instead of panic. Regional currency markets reflected macro recalibration. The US dollar strengthened, yen gained on capital inflows, and commodity-linked currencies such as the Australian dollar rose on risk-on sentiment. Emerging market currencies experienced moderate fluctuations in line with shifts in global risk appetite. Fixed income yields across developed markets moved tandem with US Treasuries, preserving manageable rate differentials. Currency stability complements the broader equity and bond market reset. FX positioning. Today highlights balanced capital allocation amid macro clarity. Commodities presented mixed outcome rotation. Gold gained about 2% as safe haven sentiment built during overnight bond yield shifts and geopolitical tension. Oil prices softened slightly, but remained supported by structured supply controls and demand stability. Industrial metals continued to face headwinds tied to China's slowing manufacturing output, but trade optimism offered support. ETF flows reveal strategic positioning across precious metals, energy, and industrial assets. Commodity allocations reflect dynamic hedging and portfolio balancing. Emerging markets exhibited resilience. China's Q2 GDP growth at approximately 5.2% supported regional optimism. Australia's stock index rallied strongly on trade optimism. In contrast, Japan displayed bond volatility amid political transitions. Southeast Asia responded well to improved export sentiment. Markets reflect heterogeneous but growth-oriented regional focus. Retail speculation remains elevated in meme stocks as Kohl's surged nearly 90% intraday on short squeeze momentum. This reminds investors of ongoing froth, even as broader markets geographically rebalance. Meanwhile, institutional caution is rising. S&P's most shorted rolling index surged over 60%. That metric reflects growing awareness of retail mania risk. Investors must weigh short-term speculative gain potential against structural imbalance signals. Venture capital slowdown noted as investors delay fintech, biotech, and AI sector funding amid macro uncertainty and rising interest rates. Deal flow volumes declined materially this quarter. Funding pivot to profitability and revenue generation metrics rather than growth potential. Early-stage startups face stretched capital cycles, enhancing emphasis on lean operation strategies. VC strategies appear, shifting toward conservative deployment. Real estate market visible cooling with lower housing starts and mortgage applications amid higher yields. Despite regional inventory tightness, affordability remains strained due to rising financing costs. Construction firms delayed or scaled back projects in target markets. Investors and developers adjusted expectations and pricing accordingly. Real estate alterations echo a broader macro rebalancing trend. Global ETF flows reached record inflows in segments like crypto-linked funds and thematic sectors including AI, demonstrating structural investor preference toward targeted exposure. Total U.S. ETF assets exceed $11.6 trillion, reflecting innovation and diversification. Active managers pivoted toward income and volatility-hedged strategies. ETF investors are now leveraging regulatory clarity in digital assets. The fund structure boom supports market depth and segmented asset demand. Credit markets remain firm as corporate bond issuance continued unabated and credit spreads remained steady. Credit stability supports macro-wide risk distribution. Fixed income markets reflect investor confidence in repricing rather than default risk. Investor sentiment metrics reflect cautious optimism, with volatility indexes ticking upward yet remaining below panic levels. Technical indicators show sustained support zones near Bitcoin's $115,000 and S&P 500's 6,300 level. Portfolio volatility remains elevated but driven by strategic repositioning rather than fear-based selling. Sentiment reset is constructive, signaling institutional buy-in. Markets are preparing for next directional leg. In closing, today's $140 billion asset shift reflects strategic reallocations driven by global trade momentum, evolving crypto policy frameworks, and differentiated sector performance. Institutional capital is repositioning across asset classes, favoring measured entries over speculative swells. Clear legislative progress and macro clarity provide foundation for renewed market confidence. Volatility today is not chaos, it's calibration. Investors who align their strategy with these signals stand to benefit meaningfully in the upcoming cycle.